all yours.
Awesome. Thanks so much. Excited to be doing this today. So as Adrian mentioned, I'm Natalie. I'm an investor at Coefficient Capital. I'm also a young professional board member for Naturally New York, which is a really great organization. So always love doing these kinds of events. So Coefficient Capital, we're a New York-based venture capital and growth equity firm based right on Union Square. We're actually in the office most days. So if you're in the area, come and say hi. And we focus on the intersection of consumer and technology. So for us, that really means any company that's consumer facing that is doing something differentiated from a tech perspective. For us, we define tech in many different ways. It could be food tech, it could be building communities online, it could be selling direct to consumer, it could be a tech platform and marketplaces consumer facing, and really anything in between. So it's a very broad landscape across what we invest, but we have a very highly concentrated portfolio. So we really only do 3 to 5 deals per year per fund. So kind of once we invest in a company, we really view them as the winner and we go all in. We like to lead investments, add a lot of value to the company, work really closely with the founders, and then we don't really invest in competitors of our portfolio companies. So with that broad space, but only doing kind of a very concentrated number of deals a year, it means we're very thematic. So we take a very thematic view to approaching. We're, a small 5-person investment team. We sit down every quarter, reevaluate what our key investment themes are. We kind of have, 5 themes going at a time. We go really deep on the themes, try to understand the space, figure out what the white spaces are, who the competitors are, and then who we think the winners are. And we proactively go after those companies to invest, lead rounds, and then hopefully make them the winners. So that's kind of where we get excited. And we have 2 funds. So we have an early growth fund and a late growth fund. The early growth fund focuses on Series A and Series B rounds. Typically, we lead or co-lead those rounds. A late growth fund focuses on Series C all the way to pre-IPO, and that could be leading, co-leading, or participating in the rounds. The check sizes we typically write range between 5 million and 20 million, but we're pretty flexible from that perspective. Again, it's the same 5-person investment team that works across both funds, and we can be pretty flexible. We have, co-invest with our LPs, so we can go higher if needed, slightly lower if necessary too. We just really like to do what's best for the company and best for the founders. So that's kind of our investment strategy. With being thematic, we also release consumer trends reports that we work with Dan Frommer, who's the founder and editor-in-chief of The New Consumer on. We release those twice a year. So at the beginning of every year, we release a forward-looking report for the full year. And then at the middle of each year, we invest like a mid-year report update. And that's really our perspective on the latest consumer trends. We do a really big survey and a lot of other external research to understand what's going on in the world of consumer. And we typically use those insights to then inform our key investment themes that we go deep on and again proactively source companies for. So that's Coefficient, and I'll give a quick overview of my background just so you guys know who you're talking to, and then I'll leave it open for questions because I really do want this to just be an informal discussion. I can kind of give like a true overview of what venture capital is, but I'd love to kind of hear about the people on this call and like what you're excited about and what you want to know about venture capital, what you already know, what you don't. But quickly on my background, is I started my career at McKinsey and Company. I was a generalist there, but I quickly got very excited about doing consumer and retail work. So I did a lot of consumer and retail work for the big Fortune 500 companies, as well as diligence work for private equity firms. I thought it was a great training ground. I learned a lot there, really enjoyed my time, but then really got excited about wanting to be closer to brands. So I also spent some time at La Mer, which is a luxury skincare brand owned by Estee Lauder. I did brand strategy and global marketing for them. So really got to be more immersed in the beauty industry, work brand side operationally, kind of got exposure there. And through those experiences, realized that I also, by being closer to brands, I also wanted to work with founders at startups and fast growing companies that were really focused on innovation. And that's what led me to Coefficient Capital. And that's kind of, what we do here today. So I'm very excited to be chatting with you guys. And yeah, I'll pause there and leave it open for questions. But if anyone wants me to just give a brief overview of what VC is, since this is VC 101, I'm happy to really start with the basics as well.
I think that's a good way to start. Actually, I'll chime in on that.
Okay, perfect. Yeah, so venture capital. So essentially we're a fund structure, which means we get funds and investments from limited partners, which we call LPs. That's what LP means, which are essentially large institutions. They can be college endowments, they can be nonprofits, they can be pension funds, a lot of different large groups of capital invest in various funds, and some of the funds that they invest in could be venture capital funds. So we essentially in each of our funds have a pool of money that come from a combination of all those different sources that we invest to then make returns for those investors. So again, so like the returns that we make from our fund go to endowments, they go to nonprofits, they go to people's pensions. So we're kind of growing these pools of money, investing them to kind of create value for those larger funds that go to like teachers' pensions, hospital systems, nonprofits, et cetera. So it's definitely very important, which, definitely gets me excited. And then what we do with that money is we invest in startups. So there's VC funds kind of across all stages. You can start at kind of angel stage very early, pre-seed, which is typically, pre-revenue, sometimes pre-even product. There's seed stage, which is a little bit after pre-seed, typically means you got to have a more built out idea, have a product, maybe some revenue, especially on the consumer side. And then you start doing the series that are kind of lettered. So there's like series A followed by a series B, et cetera. And really all of this naming can be arbitrary to a certain point, but it's essentially around is just a type of funding. So, if you're going to start a company and you're looking for your first round of funding, you might choose to call that a pre-seed. You have an idea, you have a preliminary product, but you haven't sold anything yet. So you might seek out pre-seed investors to help you with that. They have the expertise working with that stage of company and writing checks that are of that amount of money, which is typically smaller at that stage. You get that investment, you work through it as a founder. And then once you're ready, you have more of a product, maybe more revenue, you're ready for your seed stage. You then go to seed stage investors, and kind of the cycle continues as you continue growing and maturing as a business. Different investors at different stages have different levels of expertise in terms of what they help with, because they have expertise in that specific stage of company, and the check sizes they write are relevant for what stage you are. Because when you're very early, you might only need a few $100,000. When you're later at the series A stage or the series B stage, for us, you might want $5 million or $10 million, depending on what you're trying to achieve. So what we as venture capitalists do every day is we talk to startups and talk to founders, get to know them. We look at their metrics, understand their idea, go through a whole diligence process, which I'm happy to speak more about. And then once we finish the diligence process and we realize we want to invest, we partner with that startup, we give them the money we promised. And then typically we also at our stage like to take board seats so that we can kind of be helpful and give advice. And, once a company is a portfolio company of ours, they can kind of reach out to us whenever they need. And we can add value or help them whenever it's relevant. So really, we're a source of funding as well as strategic value add to startups. So when startups need money and they need strategic partners to help them think through their challenges, that's where they come to venture capital firms. And really the best way to think about going to the right firm is what is the right stage that you need to go into the firm that invest at that stage is very important. Then also what industry they invest in. So there's generalist funds that invest in everything. So if you're a consumer company, you can go to a generalist fund. There's also consumer specific funds like us. You can also go to specialists. And then the third thing to consider is what kind of value add you like to have. Some funds are very hands off. Other funds are very involved. And it just kind of depends what kind of partner you want. But really, venture capital is about partnering with startups and kind of helping them grow and succeed.
Awesome. So based on that information, for anyone on the call, is there a specific question that you would like to have addressed? Feel free to unmute yourself. And we do have one in the chat here from Lita. Sorry. For consumer startups and given the raising cost of D2C advertising, what is your view of D2C only brands versus presence in retail?
Yeah, this is a really good question because I think we've seen cost of customer acquisition, or CAC, as we say in the VC world, rising. To your point, the cost of advertising direct to consumer. And I think really it depends on your brand strategy. I think, back in the day when Instagram and Facebook were really, really efficient channels and it was cheap to, advertise on those channels, it was a lot easier. To just sell direct to consumer, and you were able to maybe buy a customer for $5. If you were selling your goods for $20, then it all made sense and you were able to make money selling direct to consumer. Now, if it costs $20 to acquire a customer and you're selling for $20, you're no longer making money on that sale, right? And I think a lot of brands are struggling with that. I think where direct to consumer makes sense is where you have a lot of repeat behavior and retention. So if it's a product that naturally lends itself to a subscription and people really stick with the subscription, it makes sense because you can spend a lot for acquiring a customer, but then if they stay with you for a year or beyond, you're going to make back that marketing investment. However, if it's a one-off product it's a lot harder because then it's harder to make back that marketing investment. So typically when we do diligence on startups, we do a lot of analysis to understand the cost of customer acquisition and how that relates to lifetime value. And some products and categories just lend themselves to higher lifetime value because they're either higher price point and higher gross margin and or higher repeat and retention behavior. If you're a very high price point product, even if you're only bought once, it could make sense to sell online because at the high price point, you're making back your investment in marketing at the first purchase. But if it's a lower price point product, you really need more repeat so that you can make back your marketing investment maybe over the course of 3 months. But then if people stay with you for 6 months, you now have a profitable customer. So definitely a very relevant question. I think it just really depends on the category, the product, the company, and what those unit economics look like. I think there are a lot of companies that maybe 10 years ago could have been direct to consumer only, and today they really need a presence in retail to make those economics work. So I think it just depends on that combination of what your cost of customer acquisition is looking like, paired with your average order value and gross margin and repeat behavior. If those make sense direct to consumer, I think it's totally healthy to be a direct to consumer company. If they don't make sense, I think it's great to keep that direct to consumer channel available as brand building, but then going into retail and having an omni-channel presence probably makes a ton of sense for you as well.
Thank you for that. That was a very thorough explanation there. Okay. Carly just added a question to the chat. How involved do you like to be with the companies you invest in, and how long do you typically hold on to an investment?
Yeah, great question. So what I like to say on this one is I want the founders to have us on speed dial, but us not to have the founders on speed dial. So essentially we're as involved as the founders want us to be. And then we're really focused on being founder friendly. These businesses are founder led, and that's really the most important thing. So if founders want us to be involved and they want to talk to us all the time and get our input on things, we're super excited and open to doing that. If you're a founder who just wants to be heads down and working on your own thing until very specific needs for us, we're also very okay with that. When we do take board seats, I think that we're at least involved every quarter because typically board seats are quarterly or board meetings are quarterly. So we'll attend those board meetings. We'll, give advice whenever asked, help whenever asked. But really we try to just support the founders and get involved on the level they want us to. And kind of across our portfolio, it really ranges. I think, again, there's some founders that we're talking to on a weekly basis driven by them, others that we're talking to on a quarterly basis driven by them. And we're very flexible with either. But we don't impose any ways of working. We kind of ask what the founder wants, and then we kind of adjust based on what that dynamic and how that relationship evolves. And maybe early on they need a lot of support and later on they need less support, or vice versa. Or maybe they just need support in very specific things. For example, hiring is often a really big challenge for early companies. And after you raise a round, you have a pool of capital and you're able to hire more, but finding good talent is hard. So a lot of our portfolio companies ask for our help with hiring because we have a great Rolodex of people that we are constantly speaking to. So we provide intros for that. If they're looking for, a chief product officer or a head of growth marketing or something like that, really difficult things to hire for. And we know recruiters, we can reach out to people on LinkedIn. We have people in our network that could be great fits for those roles. So that's an example of something that maybe when you're in a hiring cycle, we'll be really involved, but then when you're paused on that, we could be less involved. Similarly, if there's a strategic decision that you're thinking through, like expanding into a new market, I have a consulting background, so that's kind of bread and butter for me in terms of doing that kind of business analysis. And sometimes, again, startups need to be scrappy and you might not have a full strategy team to help you think through some of these things. And if we can add value by working on some strategic projects for you, we're happy to do that as well. So again, very much driven by the company and what they need in that moment. Oh, and then there was a question of how long we typically hold investments. I only answered the first part of the question. So in terms of how long we hold investments, it really depends. It depends how early we invest and kind of what's going on with the company. We typically hold them until exit. So either until they go public or are bought by a private equity firm or brought by a large strategic. So we actually had 3 exits in 2021. So Oatly, one of our portfolio companies, went public. Nom Nom, which is a pet food platform, was bought by Mars. And Just Spices, which is a German spice company, was bought by Kraft Heinz. So, upon those exits, we exit the investment, but really kind of exit is very founder driven and very team driven and very specific to each company. So, those are actually relatively shorter holds. We're a 3.5-year-old fund and you already had 3 exits. So that was very quick. But But then we have other portfolio companies that, will probably hold for much longer. So it's really a case by case basis, and it can kind of be anywhere from a year or two to, 5, 7, 10 years, depending on the company and how it evolves in its life cycle.
Awesome. We have a question from Shradar. I'm going to unmute you here.
Hi, good morning, and thank you both for taking the time today, setting this up. Natalie, the bit of question that I have is, so we manufacture different tortilla, like Indian rotis, and then we sell to directly to the retailers. And so about our revenue is around like 5 million in sales, and we have been in business for about 4 years. And we manufacture in-house. We have a warehouse manufacturing facility in Carteret, New Jersey, and then we have a second warehouse space. And then now we're looking for about like, I think, $5 to $10 million investment for new equipment that goes in. Do you guys do, besides the technology firms, do you guys also do CPG, like those kind of companies as well?
Yeah, so we definitely do invest in CPG. But I think for us, there always needs to be a tech component. So very traditional CPG, I think there's a lot of firms out there, and I'm happy to chat offline in terms of, what firms kind of fit the bill. I think there's a lot of like very CPG traditional firms out there that focus on that. I think our whole thing is the intersection of consumer and technology. So we're excited about CPG, but there also always needs to be a tech angle. And again, defined very broadly, but I think, whether it's selling online or some sort of technology that's like different in the product or IP around the product, things like that, is really kind of like our niche. Because, as I mentioned, there's a lot of really traditional consumer firms. There's also a lot of really traditional tech firms that like really only invest in tech. And I think there's not many, I think we're one of the first like consumer and tech firms together, like to really build the ground up to do both. So I think a lot of consumer firms now are trying to do more technology, and a lot of technology firms are trying to do more consumer. But really the background of our team, like each person comes from, our two founders, one has a very classic consumer background, the other has a very classic tech background. Our team is made up similarly, like, I come more from the consumer world. My colleague Anna comes much more from a tech investing world. And we kind of all like come together to like kind of complement that directly. So yes, we look at CPG, and yes, we write $5 to $10 million checks into companies that are doing, 5 million in revenue or higher. So from that profile, it's definitely coefficient, stage, and check size. But I think it's that tech aspect that we typically look for that other consumer firms are, is less important to them. So that's kind of what I said in the beginning in terms of going to the right venture capitalist. And I'd love to chat with you more and learn about your company because it sounds amazing. And I'd love to be helpful however I can. But I think just making sure that you're going to the right people who kind of have the focus and are excited about specifically the type of business you're building. Because a lot of VCs have very specific things that they're looking for. And it's important to make sure that you're using your time wisely to talk to the right people. So it's a really great question.
Thank you.
Great. I'm sorry, I missed one question from Emily going back just a minute ago. So what are some examples of strategic value add work you've done with startups?
Yeah. So I think I gave a little bit of examples when I was answering the other question, but so hiring is a big one. And then the kind of, for example, like the classic consulting background. So one of our companies, which we recently exited that sold to Kraft Heinz, Just Spices, they're based in Germany. And I think about 2 years ago, they were thinking about what other European markets they should enter next, since they were, growing and it was time to expand geographically. And that was a question that their team was trying to answer, but they wanted a little bit of support on just in terms of data gathering and analysis. So I kind of worked very closely with their team to put together a framework of, what are the main decision factors, like what would make a market attractive for this company specifically, whether it's the penetration of organic spices, the excitement of people in that country about cooking, the diversity of food within that country, like all these different things of like what's exciting about Just Spices, and like what's the list of things that a country needs to have for Just Spices to really thrive. And then we kind of put data behind that, like looked for Euromonitor data, survey data, like a lot of different data sources to kind of figure out which of all these countries in Europe is the most attractive for them, and did like a very kind of holistic, like pan-European analysis of all these different countries, like even looked at, how efficient are the marketing channels in those countries, like what is how does Instagram look in terms of spend for these types of companies in each country? And we did just a very holistic analysis to help them put together a fact base to then make a strategic decision in terms of what countries to enter next. So that's an example of kind of like a strategic project we can help on. As I mentioned, we help with hiring. Other things we do is, we're a US fund, but we have a lot of experience in Europe. So I think helping European countries come to the US and help them build out their teams and strategically figure out what US markets to enter first is something that we do a lot of work on. We also actually, have like, in-house tech tools that help, lower cost of customer acquisition and other things like that. We run a lot of surveys. Like I mentioned, we do our consumer trends report. So we always do that very large 3,000 person survey twice a year, but we also have a survey partner kind of through that report so that we can do brand specific surveys or category specific surveys to get insights. So there's really a lot of different things that we do to kind of help our portfolio companies. And it can be very broad or it could be very specific. And again, it's just, I think it's driven by the founders and based on what they need.
Excellent, thank you. Okay, I'm going to open it up again in case anybody else would like to jump in with a question. We've covered a lot of ground, I feel, already. I'm actually curious to also know like what metrics you look at when you're making an investment decision.
Yeah. So for us, because we invest at the Series A stage and above, we invest in companies that already have kind of revenue and data around them. So really the way that we think about our diligence process and like kind of across like 4 key buckets. So first is, founder and team, founder-driven companies, founders and team need to be strong, work together well, et cetera. 2 is really the market they're playing in. Is it an attractive market, a large market opportunity they're going after that's growing and in line with consumer trends? 3 is whether the product or service that they're selling is differentiated and whether there's a competitive advantage behind that. And then 4th is really the financial return, because as I mentioned, we're investing money for limited partners, and creating that return for these nonprofits, et cetera, is very important. And in order to understand what the returns are going to look like, so we definitely look across financials. So we look at the revenue growth is incredibly important, both historically and projected, to understand what is this company going to look like in 5 years? Where is that revenue growth coming from? Is it going to be direct to consumer? Is it because you're entering a retail channel, et cetera? And then unit economics are incredibly important. So we really look at, average order value or, average basket size to understand like when a customer is going there, like how much are they spending? What exactly are they buying? What are your gross margins on that average order value? So then like, what is the company actually getting? And then as I mentioned before, what is the repeat behavior? So are people coming back twice, 3 times, 4 times, 5 times? If it's a subscription after 12 months, what % of customers are still on your subscription and paying and getting product every month or so? So I think it's really understanding like that whole kind of chain of like the revenue, the gross margin, the repeat behavior, and on a unit economic basis, how much like lifetime value are you getting out of each customer and how that relates to the marketing spend that you're putting towards acquiring customers. Because ultimately a lot of these companies that we're diligencing are not profitable on like a overall company or EBITDA basis, but if they have really strong gross margins and really strong repeat behavior, you can see a path towards profitability. So I think being an early company and a startup, it's absolutely okay not to be profitable. And I think venture capitalists see that all the time. But I think the business model really needs to make sense and be a sustainable business model so that this could be, once it's a really large company, be very profitable and make sense. And I think sometimes when you kind of dig into those metrics in terms of if the gross margin is really low, or if the repeats behavior is not there, or if a company is overspending on marketing, it kind of would be an indication of a potentially unsustainable business model or a company that would have a lot of challenges becoming profitable. But so all of that is very important to us.
Great. I feel like you've touched a little bit more on the latest emerging consumer trends. Is there anything else that you wanted to highlight there?
Yeah. So there's a bunch, and we're actually going to be launching our consumer trends report in a couple of weeks, in mid-July. So all of like our latest thinking is going to be in there. We just, finished fielding our survey. So we're going through all of the really exciting consumer insights. So I'm excited to share that with all of you guys once it's ready. But right now, I mean, in terms of like, for example, like thematically, what we're looking at is we're thinking through alternative protein is a really interesting space. I mean, really, when we think about consumer trends, we think about irreversible consumer trends. So what are consumer behaviors that are like really large behaviors that are changing and are unlikely to go back? So plant-based or like the move towards being a flexitarian is something that once people realize that they want to eat more plant-based and don't want to be, and like they for whatever reason it is, whether it's, you know, animal welfare or environment or health, it's unlikely for people to like revert fully back to being meat eaters only and never eat plant-based again. Like once you kind of go plant-based or go flexitarian, you're probably going to stick with that. Similarly, once you start feeding your dog fresh dog food, you're unlikely to revert back to kibble. Of course, there's exceptions to these things, but I think these large irreversible trends are what we're excited about. And I think that's the difference between a trend and a fad. I think the fads can be really interesting and important to understand and could turn into irreversible trends once they're like larger and more built out. But I think that's kind of how we think about it in our minds. And yeah, so like right now I'm very focused on alternative protein in terms of like the flexitarian movement. We're specifically excited about whole cut, alternative protein, and cheese, given that those feel like they're two interesting white spaces. We're really excited about pet nutrition. So, you know, we had a fresh pet food company that sold to Mars that was Nom Nom. Again, like when people start feeding their dog fresh, they're unlikely to go back to kibble. But there's a lot of other white spaces in pet nutrition and pet health in general that are really exciting. You know, a lot of people got pets during the pandemic. Millennials and Gen Z like really continue to treat their pets like family more and more each day. Again, these are large reversible consumer trends. Happy to go into some more of them, but those are just some off the top of my mind. And then there'll be a lot more that we're going to be discussing in the trends report, which will be released in July.
Awesome. And we'd be happy to route that as a follow-up to everyone that has RSVP to today's event. Okay, great. And then on valuation, what's the typical EBITDA or revenue multiple you are looking for in current portfolio companies?
Yeah. So I guess I'll answer this question both on valuation in terms of like us entry valuation when we invest, but then also exit. And it's kind of the same. It's sort of the same for both, right? Because it's hard to give like you a specific EBITDA or revenue multiple because it's so dependent on the category, the current market dynamics, the growth of the company, and the company itself, right? Because like companies, even if like on face value look like they're similar across their category and their products and their growth, like once you dig deeper, actually could have reasons why they have higher multiples or lower multiples. So we don't have like a single multiple that we look for, even by category. But we do this analysis for each category and for each company specifically. So we definitely look at public multiples as comparables. So, you know, if we're looking at, you know, like if we're looking at a delivery food company, we'll look at, you know, where is Grubhub trading, where is DoorDash trading, where is Delivery Hero trading, et cetera, on an EBITDA basis or an EBITDA basis as well as a revenue basis. A lot of these companies that we're looking don't have EBITDA, and a lot of their comps don't even have EBITDA since they're not profitable. So a lot of this is actually done on a revenue basis. And these public comps change constantly. So you can't, you know, change your view exactly at the whim of the public markets. But I think understanding kind of the trend over time of these revenue multiples for relevant public companies is really important to kind of give you a baseline for what multiples look like in the space. So that's kind of how we think about category. But then you also have to, you know, think about the growth of each company. So you can have two very similar public companies, or at least that look like they're similar at a face value, but one is growing much faster than the other. So they might have very different multiples, right? Like the fast growing one might have a higher multiple, and the slower growing one might have a lower multiple. And if you just take the average, then you're looking at a number that's an average and you can apply that and maybe it's an okay benchmark. But I think really understanding how multiples are impacted by revenue growth rate is very important as well. Because again, a lot of the companies that we're investing in, a lot of our current portfolio companies have very fast revenue growth. So typically lend themselves to those higher multiple comps. And you can say, oh, maybe you're cherry picking high multiple comps. And the way to make sure that you're not cherry picking is to really, again, dig into those companies. what is their revenue growth rate? Like, why are they trading at higher multiples? Is it because they have this specific competitive advantage and because they're growing faster, et cetera, et cetera? So there's no, single multiple that we look for, but we do very deep analysis of the public markets as well as comparables of like, what large strategics have bought companies for in the past, what other VC funds have invested in companies in the past at what multiples, and really just look at the market to understand what that looks like. And we really try to like get into like the deeper levels of why and what's driving those multiples as opposed to just like using a blanket number. And I know that that was a lot and was a little bit technical, so I'm happy to answer follow-up questions if it didn't make sense or if I kind of got a little too financy. So I will pause and you guys let me know.
I think they liked your answer. All right. Many of the metrics that you had spoken of earlier when evaluating a company were D2C based. Can you give a sense of how you would evaluate investments in more retail based brands?
Yeah, absolutely. So it is really different. This is a great question. So definitely for retail, we're very focused on velocities. So kind of understanding the units sold per store per week and the dollars per store per week, especially in relation to competitor brands. Like who are you sitting on shelf with and who is turning faster in the retailer? I think that's kind of the baseline metric that we look at for retail businesses. And then we also really just want to understand what specific retailers you're in, how many doors for each retailer, how much are you spending in trade spend for each retailer, and what is kind of the return on that investment of trade spend. And then what is the growth plan? So, kind of when you think it like velocity is very important because different categories and different retailers have different kind of velocity benchmarks. And that's why I think looking at it in a silo of just your numbers, while that's helpful too, it's really important to look at it holistically across the category, retailer specific, right? Because, I was speaking to hair care brand the other day, and it sounds like for hair care specifically, like Ulta and Target have very similar benchmark velocities. If you're in Walmart, like that category just naturally has lower velocities. And if you're in CVS, it's even like naturally lower than that. So it's, you don't want to compare like your Ulta velocities to your CVS velocities because that's an unfair comparison just by nature of how people shop that retailer. But you do want to compare within Ulta like how you're doing with other brands, and then within CVS, how you're doing against other brands. So kind of that comparative velocity metrics are incredibly important. And then as I started to say before, just in terms of like retail growth, like what are the next retailers you're going into? What are the next like number of doors you're going into? Like maybe you launched in 30% of Targets. How are those performing? And kind of what does Target want to see in order to bring you into 50% of Target doors? And then what are they going to need to see to bring you into 100% of Target doors? Like what are the retailers looking for as well? Because that's really going to impact growth, because ultimately growth is driven by like entering more retailers, within those retailers entering more doors, and then within those doors selling more product. So really understanding kind of those three things and how they come together both on your current business and then what the path is forward to really understand what the revenue potential is at retail.
And do you have any advice or guidance for someone looking to break into the consumer VC space?
Yeah. So definitely reach out to me. We can also talk more one-on-one about that. Always happy to help people who are excited to enter the VC space. I mean, I really think VC is, it's very relationship and network driven. So I think cold reaching out to people is absolutely okay. I think it's one of the industries where people actually respond to cold reach outs, which I think is pleasantly surprising to people not in it. I think cold reaching out can be very daunting, especially, depending on what industry you work in currently. But within VC and the startup world in particular, I think people are open to cold reach outs, they're open to conversations. And so hopefully you find that to be the case. I would hope that most people respond. I typically, always try to respond to cold reach outs. So I think, if you're interested in consumer VC, figure out what firms you're excited about. I think that's going to be driven by what stage in particular in consumer. Like, do you want to do pre-seed consumer, seed consumer, series A, growth stage? There's all these different options. Kind of figure out what kind of companies you want to be investing in, what stage, what strategies you like, research different consumer firms, and just, cold reach out to people, chat with them, see if you like the stage and the strategy that they have. Because again, each firm, even if on the surface, like their websites might look similar because they have similar portfolio companies, each firm is actually extremely different in their focus, their stage, how they invest, how they think about investing, and then also culturally. So I think it's really important and kind of do the work, look at all the different firms, reach out to people, cold reach out. Once you cold reach out to someone and they answer and you're talking to them, ask for intros to other people at firms, like, hey, I saw you're connected to this person on LinkedIn. I'd love to chat with them. Usually people are really happy to do that. So I would just say, put yourself out there, figure out exactly what you're going after, and then, reach out to people. And there's also, if you're specifically looking for jobs right now, there's a bunch of blogs and newsletters of VC jobs. There's the John Gannon blog. He publishes a lot of VC opportunities. All Raise, which is a women's group, has a jobs newsletter that they post. Sutton Capital, I think, is a recruiting firm that has a jobs newsletter. I get they send so many emails every day of different positions open. So there's a lot of newsletters out there to kind of understand and have a pulse on the market of what's going on. You can also reach out to recruiters because they're constantly recruiting for VC firms too. People like True Search and things like that. So there's a lot of different ways to kind of hear about job openings, whether it's newsletters, talking to people, speaking to recruiters, et cetera. But then again, I think just really speaking to people in the industry, building those connections and helping use that to figure out what you're really looking for is going to set you up for success as opposed to casting a wide net. I know some people do cast a wide net and that can work very well. I think my personal view is it's better to be very targeted and direct because each experience is going to be different. And you probably want to figure out exactly what you're excited about to make sure that you're getting the job you really want, as opposed to just any job in VC, which if you're fine with any job in VC, it's also an absolutely fine strategy. But if you have a very specific vision of what you want, I think it's worthwhile to go after it.
Awesome. We have about 20 minutes left. We don't have to take up the full hour, but opening it again to any questions from anyone here on the chat. Thank you again for participating today. I think this has been pretty informative all around. Again, we've touched a lot of different areas. Curious for you, Natalie, what is your favorite and least favorite part of being a venture capitalist?
Yes. So my favorite part is working with founders and just getting to talk to founders every day, hear their passion for what they're building and all their creativity and solving these unique problems in really exciting ways. And just being part of the entrepreneurship ecosystem is incredibly empowering. And I love that I get to talk to founders every day and help them, even if they're not our portfolio companies. I love when companies become portfolio companies so we can give them capital to realize their growth visions, and then work with them really closely and add value there. I think that's the most empowering part of the job is working with founders and seeing businesses grow. I love that. And the least favorite part is, we only do 3 to 5 investments per year per fund. So we talk to a lot of founders and we can't invest in all of them, even if their company's absolutely incredible. It just might not be the right fit for Coefficient. As I said, we have, very specific investment criteria and mandates, and a company could be an absolutely fantastic company, but just not the right fit for us to invest in. And I think that can sometimes be the hard part of the job. Is not being able to invest in a company that we may want to, or, having to pass on a company that we know is going to be fantastic, but just not the right fit for us. And I try to mitigate that by still staying in touch with those founders and helping them personally whenever I can. But kind of that can sometimes be, the sad part where it's I'd love to invest in more if I could.
And any other advice you would have for founders who are currently fundraising?
Yeah. So I think, as I mentioned a little bit before, is be very targeted in terms of speaking to funds that very much fit the stage and type of company that you are. I think it'll, set you up better for success. Again, similarly to recruiting for a VC firm, just making sure that you're going after the right funds. And then really just I think being authentic and transparent is incredibly important. I think it's important to diligence the funds as much as they diligence you. Obviously we have a very rigorous diligence process where we go through all the financials. We do a lot of like external research. We like speak to a lot of the team members. We go really deep to like understand if a company is the right fit for us to invest. And you as a founder, when you're doing fundraising, should go equally as deep on the funds that you're seriously considering, because it really is a two-way street and you're entering into a very long-term partnership. And I think entering that conversation with authenticity and transparency can help you determine whether this fund is going to be a really good partner or not. It's okay to speak about things that are challenging. It's okay to not have the answer to every single question. I think kind of viewing it as a partnership from the beginning, at least for us, is really important, because we like to work closely with our portfolio companies. We like to build those like true, authentic relationships, and we really want our founders to be transparent, open, and honest with us so that we could be as helpful as possible. And I think kind of starting off the bat like that is really good. And then making sure that it's reciprocated by the fund, making sure that you also feel like you're getting authenticity and honesty from the investors you're speaking with, and diligencing them, ask them to speak to some of their portfolio companies or founders they've worked with in the past, ask around, kind of make sure that you're comfortable and excited about starting a partnership with them. I think it's important.
Awesome. And we have another question. From your experience and what you're seeing in the market currently, could you shed some light on how VC investments are looking in the supply chain and inflationary period?
Yeah, so it's definitely a really interesting time in the market right now. I think there's a lot of uncertainty. We're seeing high inflation, we're seeing supply chain disruptions, we're seeing the public markets going crazy as well. And I think, people are saying like, oh, a recession is coming, or a recession is not coming. Just there's a lot of uncertainty. And I think there are some firms that respond to that uncertainty by just pausing investing. So I have spoken to some of my friends at different funds, and they're just like, we're pausing for the next 30 days, we're pausing for the next 60 days. We actually are still incredibly active. So we actually just closed like 2 deals in the past month, which has been really exciting. One was a follow-on investment, which was actually, that one was public. That was like Magic Spoon, which was really exciting. And then another one, which is not public yet, but hopefully I can talk about soon. So we've continued to be incredibly active, and we're very excited about continuing to work with companies, especially at the earlier stages where, of course, these larger economic issues matter for everyone. But in terms of later stage companies, if you're looking at the public markets, it's a little bit more relevant for later stage companies because you have to worry about exit. And again, going back to the multiples conversation, those public multiple comparables might be more relevant to later stage companies if they're going to exit soon. But for earlier stage companies, you still have a little bit of time. You have a few years. The markets are going to change. The economic situation is going to change. You just have to make sure that you have enough capital and the right partners to help you ride out that wave. And yeah, so I mean, in terms of inflation in particular, I think we're actively tracking those metrics. We're going to do quite a lot of that, of our perspective on that in the report that we're going to be putting out in July. I really think that these things are very challenging to founders with supply chain and inflation. And I think making sure that you're equipped for that, like I said, being well capitalized, having the right partners, thinking through how to solve the issues. If you as a company are facing inflation in your raw materials, it's a strategic decision of whether you're going to pass it on to your customers. Do you raise prices? Do you not raise prices? I'm sure if people on here are consumers of startup companies, I'm sure you've gotten a few emails in the past month or so from a company saying that they're raising their prices. And I think that strategic decision could make a ton of sense. And I think the startup companies that are sending those emails are being incredibly transparent as to why they're doing that. They're not secretly raising prices and not telling anyone. They're actually sending an email to their customers. They're explaining why. They're explaining that inflation, supply chain, et cetera, their costs have gone up. They need to keep their business running, et cetera, et cetera. So I think that all of these things, all the implications, price raises to customers, stock outs, things like that inflation and supply chain impact, a lot of it is just, again, about being transparent and authentic with your customers, transparent and authentic with your investors, and trying to figure out how to solve the problems creatively, and in a way that's in line with your values. Obviously these things are incredibly challenging, but you want to make sure that with each challenge, you get the right support and that you respond according to the values of your company. And that is on brand and in a way that you want consumers to see you and understand you. So it's definitely a challenging time. We're definitely working really closely with our portfolio companies to help them through this in any ways that we can, and offer strategic advice, support, et cetera. And then we're still investing in companies. And then even if we know that they're having struggles with some of these things. Like these things come and go, like challenges get more challenging or less challenging as like different things happen in the economy. And I think you really just have to take a long-term view on what to do best for your business in the long run. And I think sometimes that can be really challenging, but I think having the right people around you could help just kind of make sure that you're constantly doing what's sustainable and long-term for your business.
That's amazing. And where do you see yourself in the next 2 to 5 years?
Oh, interesting. I don't know. I mean, I love Coefficient, so I very well could see myself very much still being here at Coefficient investing. We have our early stage fund, which we've been investing out of for over 3 years at this point. We have our late stage fund, which we just recently started investing out of. So there's still like a lot of runway left in our funds, like at least for the next 2 years, like maybe even longer. If these continue to go well, we'll probably raise more funds. So we're actually expanding the team. We have a new person joining in a couple of weeks, which I'm really excited about. Might have another one joining as well. So, I'm really excited about kind of Coefficient's growth as a, major VC firm in the consumer and tech space. So I definitely could see myself, staying here for the long term. And then if not, I've always kind of thought about potentially maybe being an entrepreneur. I don't have any ideas right now, but I grew up surrounded by entrepreneurs. Like my parents started their own business. My brother is a founder. Like 2 of my cousins started their own companies. I grew up kind of surrounded by entrepreneurship. And I just think that that's something that throughout my entire career, I want to continue supporting. And I feel right now, the best way for me to support entrepreneurship is through the work at Coefficient. I absolutely love this team and love our portfolio companies and everything we're doing. So very much could see that. If I were to do something else, like potentially that's on the table. But really, I don't know. I don't like planning too far in advance. I'm going to just see where it takes me, but really love venture and love what I'm doing. And the people here at Coefficient are the best. And I do think when you're thinking about a career and where you want to be, being surrounded by good people is probably my number one priority.
I couldn't agree more. Thinking of a 5-year plan is really hard for me.
Yeah.
Two is a stretch as well.
Exactly.
Let's start with 2 months personally.
Yep.
Okay. And then on average, what's the timeline of your investment process?
Yeah, so it ranges a lot because we're a small team. Like I said, currently 5 people on the investment team. We could be super quick, right? Like if you need an answer in like a week or 2 weeks, like we could do that. We're very lean. We work really fast. We typically know what we're looking for. So we can be very quick. But given the fact that we only do 3 to 5 deals per year per fund, and we're really high conviction and we like lead investments, take board seats, et cetera, we like to have a lot of comfort, which is actually why we like to also meet entrepreneurs early. So sometimes we might talk to entrepreneurs who are raising their seed, and we know that that's not going to be a fit for us because we don't invest seed stage, but it's great to get to know that company, get to know the team, the founders, understand what their metrics look like now, what their strategic vision is, just get really comfortable with them as a team. And that also gives them the opportunity to get to know us so that when like Series A comes, we've already been speaking to that team for a year. Like maybe it started as like an initial fundraising discussion, but we're not seed investors, but I'm still really interested in understanding your business. Then we kind of keep in touch. We get investor updates quarterly from them. We grab lunch with them once in a while. They come by the office to get to know more of the team, like send metrics as they become relevant. And then when they're ready for their Series A, we then can make a decision really quickly, like I said, a week or 2 weeks, but we've really already built that relationship over a year. So it really varies. And again, we can make a decision in a week or 2, even without knowing the founders for a year, but we don't love to do that. We prefer to build really long lasting relationships. I mean, a great example of speed actually though, where we did make a decision very fast is, we just recently invested in a company in Germany, which I can't share the name of yet, but we had started speaking to them maybe, 2 to 3 weeks prior to signing term sheet. And 2 weeks into that conversation, we, get an email that they've already gotten term sheets in. We're like, oh, this is process moving a lot faster than expected, but we're really interested in this company. We love the founders. Like we might actually, even though it's not a long-term relationship and it's only been a week or 2, probably want to put a term sheet in. So get on Zoom at like 2 p.m. that day, hear about the term sheets. They're like, really, this is a Wednesday. They're like, we need to know like by Friday. And then, so we're like, okay, we have 2 days to put in a term sheet, but these guys are in Germany. We've never met them in person, very new, like hang up the Zoom at 2:30, open up Kayak to look at flights. And we're like on a plane to Berlin by like 6 p.m. that same day. So because we're like, we got to like meet these guys, right? So we're like, we love this company. We're really excited. We've done a lot of work up front, but now it's like, oh, term sheets are due. And like, we didn't realize it was going to be this fast. Like we just flew to Germany, spent 24 hours with them, like went through the whole business model, went through their Excel model, like talked through everything, like met their entire team and like got super excited and then put in a term sheet that night. Right. And then ultimately like won the deal and like they're going to be a portfolio company now. And once it's public, I'll share it with you guys. But, you know, that's an example. Like our investment process can be very fast and we have done it before and there's case studies of it. There's also case studies of it being a year or two before it's the right time. Because we're so stage agnostic, you know, we're Series A and above. A lot of the question is like, it's not if, it's when. So like, even if it's a Series A, we still have the flexibility to say like the A is not right for us, but maybe the C will be right for us. And it's really like part of our decision-making process, like when is the right time to invest because we have so much flexibility. So it can be years if you consider the relationship building phase, the investment process, or it could be less than a month, couple weeks, if it needs to be. So I know I didn't give you an answer because you specifically asked on average. I don't really know how to give you an average of years and weeks. But really, like I said, like incredibly founder focused. So whatever is kind of needed for the process is what we do.